Well, nothing has changed. Nothing has changed except the stock prices have come down. We're in bargain basement territory if our view on innovation is correct.
Hey everyone, I hope you're having a nice weekend. You know, I like to do a vlog kind of style video for you guys at the weekend every single week. And this week, guys, we're going to be discussing Cathie Wood because there's some fantastic news out. Cathie Wood gave an interview at markets close yesterday, about 20 hours ago. So I am going to put this video together for you with the clips of Cathie Wood from Meet Kevin, because he actually went live on air with Cathie on the CNBC show. And I will be showing you those clips about what she said about the markets and how the markets are being so reactive right now, how the bull market is broadening out, and how this is a really good thing for innovation stocks and growth stocks. The worst thing that can happen is for obviously innovation to narrow and all of the money to feed in and continue to go up, because it will lead to a massive crash. And this correction is in fact a buy the dip opportunity, because the innovation platforms that will start to be created and will accelerate into the coming next like 5 to 10 years, we are going to see a huge adoption into a lot of these players like Tesla, into our players like NIO, for example, and into PALANTIR. So I'm really excited to bring you this clip today, and all I ask is that you go down there, as always, smash that like button for me, and also hit that big red subscribe button. Let's try and get this channel up to 4,000 subscribers by the end of next week. That is my goal for you guys. I hope you are having a lovely weekend, and let's hear what Cathie Wood has to say. I'm pretty excited about this video.
We made on this sort of current pullback, do you actually welcome that as a long-term buying opportunity for a lot of the stocks you love, or are you feeling the heat a little bit?
Oh, I love this setup. The last time I was on, I think I said that this rotation was good news, because it meant the bull market was broadening out. It was strengthening. And the worst thing that could have happened to us is to have the market narrowly focus on just our ilk of stock, the innovation space. Instead, it has broadened out so that year to date, I think it's energy's up 40%, financials are up 27%. And from the peak, in mid-February, our strategies are down. The ones that have been hit the hardest, not all of them, are down 30 to 35%. I love that setup. From our point of view, 5-year time horizon, nothing has changed except the price, and therefore the return, which at the peak of the market and of our strategy in mid-February, we expected a compound annual rate of return of 15% on average per year from our strategies. Now that the prices are down, that number is somewhere in the 25 to 30% range.
Cathie, I wanted to talk Tesla, one of your favorite stocks, because that's part of the performance issue. It's off 25% from the highs. And there's some real questions right now about the reliance on autopilot and whether that has led to some deaths. You have been super bullish on Tesla's autonomous future and the vision of robo-taxis. Isn't that problematic, given some of the concerns here around safety?
Actually, I think we've gotten some very important information recently that Tesla is seeing its way through, so to speak, to autonomous. And that is, they've decided to take radar out of the ecosystem and just depend on vision, computer vision, CV, so 8 cameras. I think they're getting much closer. And, as far as autonomous, when anyone talks about safety in an autonomous vehicle, they have to consider the alternative. The alternative is human-driven travel. Humans are responsible for 80% plus of all fatalities in automobiles. And so autonomous is going to really take that issue away from us. There's the good deflation associated with innovation, which spurs dramatic growth. So really good. And to give you a sense of the drama in terms of the deflationary undercurrents, undertows, that innovation is starting to pull on the economy, we use one of the most dramatic in DNA sequencing. Now, healthcare is almost 20% of GDP. and it's never seen deflation except for patent cliffs, and that's a very bad source of deflation. Healthcare, I don't think, has ever seen good deflation until now. So DNA sequencing costs for every cumulative doubling in the number of whole human genomes sequenced, and we're in very, very early days now. So we're going to see a lot of cumulative doublings. For every cumulative doubling, costs decline 40%. This is a bit of a shock to analysts who have watched healthcare and know nothing but inflation and actually base their models on inflation. In the battery space, battery pack systems for every cumulative doubling, and we're in very early days of electric vehicles, so we're going to see many cumulative doublings. Those costs drop 28%. So think about that. In the transportation sector, deflation driving a boom in electric vehicles. We're seeing the same in industrial robots. I think it's roughly 25% there. We're seeing artificial intelligence training costs drop anywhere from 37% to 50% per year. So, and artificial intelligence is going to permeate every sector, every industry, every company. And those companies not embracing it the way they should are going to lose out competitively. I am wondering if we're going to see much in the way of tax increases, as I just mentioned. We know that the corporate tax rate will probably not go from 21 to 28%. Perhaps it will go to 25%. That seems to be the compromise brewing. On the economic indicator front, now we still believe we're in a V-shaped recovery, and that there will be nothing getting in the way in the short term. In fact, businesses continue to scramble. They cannot keep up with what's going on out there. Now, you wouldn't know that from the employment report we just got today. The employment report was quite weak relative to expectations. So an increase of 266,000 in non-farm employment. The expectation was close to 1 million, an increase of 1 million. And if you take the downward revisions, the net employment increase was closer to only 188,000. So what is going on if businesses are scrambling and can't meet demand? What is going on is if you pay people not to work, they won't work. And I think a lot of companies are having trouble finding help. And in fact, one of the important clues of that is, and I've never seen anything like this, is temporary employment dropped 111,000 in 1 month. What does that tell us? Facing a very interesting issue, so businesses scrambling, productivity increasing, pricing power increasing. What this is telling us is profits are screaming. And last year, I remember talking about a V-shaped recovery where by the end of 2021, perhaps we would see an annualized rate of S&P earnings at the $200 range. It looks like we've passed it already, and that we could be at 250, 260 moving into 2022. And with the S&P at roughly 4,200, that means we're looking at a multiple of 16 to 17 times, which given interest rates in the 1.5% range, which is where we are in the 10-year Treasury yield, that is a very modest multiple.
So thanks for tuning in today, guys. I hope you had a great time listening to that. I hope it gave you a lot of reassurance and affirmations as to why, in fact, you are investing in the stock market and also a long-term time horizon. Cathie Wood believes that we should be holding these stocks in our portfolio for 5 years minimum, and now we can expect to have a return of about 30% plus in each of these plays over the next few years because they have seen such a sharp correction. But once, obviously, this market has now broadened out and these plays start start to come alive, we are going to see a nice adoption back into the innovation space, as again, we do have a lot of disruptive innovation that is going to change history and of course change the future. So very, very, very exciting time to be alive and also to be an investor with so many opportunities around us. So if you are panicking and again your portfolio is red, then hopefully this has given you a lot of reassurance. So go down there, like I said, smash that like, smash that subscribe, and I'll see you guys in my next video. Ciao.
Well, nothing has changed. Nothing has changed except the stock prices have come down. We're in bargain basement territory if our view on innovation is correct, the 5 innovation platforms. So if the return expected at the beginning of all of this was 15%, then the return expected now, again broadly, should be in the 25 to 30% range per year on average during the next 5 years. I love the setup, and we do think the bull market has broadened out, and we're looking forward to innovation joining the party once again.